the entire monetary system is based off of fraud, theft, and enslavement. You borrow $1 million, and over 30 years, you're going to pay back $2 million. Except at first, it's almost all interest that you're paying. You're not paying down the principal for the first few years. That is a form of enslavement. They're making a living off of you at no cost to them.
What do we do? I mean, how do we get out of this system that it has been predetermined for us?
We've had 4 different monetary systems in the last 150 years. The world is overdue for the next one. It truly looks to me like we're going to go back onto some gold standard. National fiat currencies are a scam that enslave us. Money, gold and silver, sets you free.
What would happen to home prices and the stock market if we went back to a gold-backed dollar? I mean, that would be catastrophic at some levels, wouldn't it? Mike Maloney, welcome back to the show.
I want to thank you for having me. How are you doing?
I'm doing great. I can't complain. It's a lot to talk about in financial news. I can't wait to talk about a few things. I have a lot of questions for you. It's always an honor to talk with you. And I know when we spoke earlier, you mentioned that you are busier than you were during the 2008 great financial crisis and that time frame. Your book's solid with speaking engagements, but you made time for our audience. Thank you so much.
You're welcome. It's a pleasure to be here. You had me on your show a little over 6 months ago, and I hope some of your audience took action, because gold was about 2,500 then, and it hit 3,500 recently. And you're never going to see 2,500 again. I don't believe that that's going to happen. And I think the first time, when was it that you were in Puerto Rico?
Oh my gosh. A year and a half ago? Something like that. Yeah. Probably November a year ago.
So it was probably around 2,000 then instead of 3,500. So, yeah. So that's gold.
Well, for those who right now are saying, who the heck is Mike Maloney? You're a best-selling author. You have an amazing video series called The Hidden Secrets of Money. You're the founder of goldsilver.com. You're one of the highest regarded investment education companies in the world, and you're a global leader in gold and silver sales. I have all of your links drop below in the show notes, and I encourage everyone to check you out and check out Mike's YouTube channel as well. You'll find that video series. Absolutely amazing job that you did putting that together. We'll get started.
Yeah, we started that. I think the first episodes are more than 10 years old now. So I've got something else that'll come out someday, so probably toward the end of the year or early next year. I've got something that I hope will surpass Hidden Secrets of Money. Hidden Secrets of Money sort of follows the history of money, but it opens up and I'm standing in front of the pyramids, and then the next episode I'm up on the Acropolis. But it shows you how those events of the past reflect on your life today, which I've never seen in any other, history of money type of video. And there's a lot of economics in it. And there's some predictions that haven't come true, that didn't come true yet. And there's a bunch of them that have come true. And so, it's something that we're fairly proud of. And then after the interviews with you, I released The Great Gold and Silver Rush of the 21st Century. I don't think that was out yet with the last time that we did an interview, which has become the best-selling book on investing in precious metals.
Well, we'll have to publish that link as well. I'll have to get it also. Can you give us a little sneak peek into what you're working on, the series that you're about to launch?
Well, all I can say is that it's purely economics, and there's no monetary gain that I can get out of this. This is something where I'm trying to make it so that the world, so that anybody from 9 to 90 can understand the economy. And when the way the modern monetary system works, it The way currency is brought into existence today, and I always I always try to use the proper terms. We do not use money. Your audience has probably never used money. Some of them did when silver was still in circulation. I actually pay for things in gold. Aristotle was the first person to define the attributes that something has to have in order for it to be money. It's got to be a medium of exchange, a unit of account so you can put prices on things, and it's got to be a store of value. And even if you go to the Federal Reserve's website today, just Google, say, what attributes does something have to be considered money? And the link that comes up on the Federal Reserve's website is they say that first, it must be a store of value. Well, the dollar used to be worth 1/20th of an ounce of gold. Now it is worth 3,300th of an ounce of gold. So it's it's a 99 point something percent devaluation of the currency. It isn't the gold that changed, it's the currency. And so gold is a store of value. Gold and silver are the only things that have proven to be money throughout the centuries. The US dollar, what's happened to the value of the dollar in just the past 5 years? Has the cost of living gone up? Well, that isn't the cost of living. That is the purchasing power of the dollar going down. The cost of living is basically the same. If your pay has kept up with inflation, it's still the same number of hours that you work to pay for your life. But most people's pay has not kept up with inflation because the value of the currency keeps on going down. And that happens because of dilution of the currency supply, mostly. There is something called cost push inflation. There's velocity of currency. When it's high, we experience some inflation when the dollars are changing hands real fast, when the economy heats up. But then when it slows down, the inflation goes away. The Coinage Act of 1792, I think it was, until the Federal Reserve, there was little inflations and deflations, but basically, for more than 100 years, the price of bread, the price of a house, it was the same. It didn't. And, if you stop measuring things in dollars and you start measuring things in other stuff, and so you have to go to some place where you can generate your own charts, and you you take a long-term chart of the Dow Jones or of real estate, and you divide it by the price of a barrel of oil or gold or, the S&P, you're a house divided by the S&P 500, you're going to find that nothing goes up. Everything is trapped in this valuation range. I call it wealth cycles. And whatever you're measuring it with is doing the exact opposite wave. And so to me, the trick is buying the assets that are undervalued. And you sell the overvalued asset, buy the undervalued asset, and ride the next wave up. You're escaping this channel and you're gaining true wealth. Do you know that in the 70s, if you had sold a home, your home, wherever you lived, and purchased silver, by January 1980, when silver peaked, you could have sold your silver and bought 19 homes with the proceeds of the same type of home that you sold in just 8.5 years. And 19 times gain in true wealth, not measured in dollars, because the dollar, we had raging inflation. Dollar was going down at the time. In fact, from 1966 to 1982, the Dow Jones Industrial Average bumped its head on 1,000 points in 1966 and couldn't break through until 82. So it's 16 years of this excruciating grinding sideways. However, when you adjust it for inflation, it was a 73% crash of the stock market, and nobody saw it. It's called the invisible crash. If you had 100,000 in the stock market in 66, you still had 100,000 in 82, but the purchasing power of that 100,000 had gone down by 73%.
I hope you're enjoying the interview so far. I just wanted to take a brief moment and let you know that this podcast is brought to you by SachsRealty.com. Here at Sachs Realty, we're committed to bringing you the best real estate education and helping buyers and sellers achieve their real estate goals. If you haven't subscribed to our channel, please consider doing so now. And don't forget, we're on every major social media platform, so you can follow us there as well. Now back to the show. Well, Mike, consumer debt is at a record high. Inflation, like you just spelled out for us, has robbed us blind. The middle class is cash poor. Why haven't we seen a financial market crash as of yet?
Oh, well, you're about to because of the tariffs. We've already had an economic contraction for the first quarter of the year. 2 quarters in a row it constitutes a recession. The tariffs are not a tax on China. All they do is punish China and slow down their sales. But if you're importing big screen TVs, you're also punishing Best Buy because you're slowing down their sales and their ability to pay their workers, their salespeople, and so on. And therefore, there's going to be layoffs. So we're probably going into a stagflationary period. But the importer of those TVs, whoever it is that's the importer, has to pay that tax. So it's a tax paid by an American to the United States of America. It isn't this windfall profit where we're charging China something. And so it slows down sales, but it also slows down global sales. You've slowed down production in China, but then there's less stuff being shipped. So the shipping companies are going to have less action. They lay people off. The docks, the ports in the United States are going to have to lay people off. So eventually, you're going to see unemployment rise, and so that means if you've got this added cost of a tax of 30%, 50%, whatever it's determined to be at the time, that has to get passed on to the consumer. We can't pass it on to China. If a Chinese manufacturer is selling wholesale, it's a very competitive market. In retail, most people make about, they mark something up 50%. So of the total cost, you've got a 1/3 is your net, your profit margin that you're charging. And in the manufacturers in China might only be making 10%. Because they're doing it in volume and it's a wholesale environment. If you impose 100% tariff, like we had 145 was what was proposed and put in place and then rolled back recently. But if you've got 145, how do they drop their price when they're making 10% to compensate for that? They can't. They just end up selling a whole lot less because the American importer has to pay that 145% tax on whatever they bought it for from China. And then, in order not to go broke, they've got to pass that cost on. And so the cost of the TV at Best Buy has to go up by 145%. And so it comes out of your pocket and my pocket, and then goes back to the U.S. government. So it's just another tax placed on us by the U.S. government. And, if I haven't read The Art of the Deal, I guess I should. I know a lot about it, though. I've read about the book. I haven't read the book. But if this is a negotiating tactic, we better get the negotiations done quickly, because this has the ability to plunge the world into a global depression, much worse than the Great Depression. The world is so interconnected. During the Great Depression, a lot of the same things happened. The stock market crashed first, but then we passed the Smoot-Hawley tariffs so the last time that we tried this was 1930, and it took what should have been a very severe recession and turned it into the Great Depression. That, and then devaluing the dollar in 1934 against gold. So this playbook has already been tried. and it ended up with very tragic results. I was watching a clip that was Milton Friedman, and he was talking about an analogy that Ronald Reagan had done. If you're out in a boat with a couple other guys, three people in a boat, and one guy pulls out, out in the middle of the ocean, one guy pulls out a gun and shoots some holes in the bottom of the boat. Are you going to pull out your gun and shoot more holes in the bottom of the boat in retaliation? And should the third guy, all you do is sink faster. Tariffs hurt the importing country the most, and then they hurt the exporting country as second. But if you take a look at, every stage through the supply chain, the price goes up and more people get paid. And so you're hurting the manufacturer in China, but you're hurting the shipping company. You're hurting the people at our ports that are Americans that are making a paycheck. But a bunch of those are going to get laid off. Then you're hurting the importer, and then the importer is going to sell it to a retailer, and all the way up the chain, the costs are passed on. So the costs are higher and higher and higher. So the shrinkage to GDP by slowing down the sale of imports is much larger in the importing country, where it's going from wholesale prices to retail prices, than it is in the exporting country. So we are hurting ourselves much more than we're hurting China by doing this.
Well, what is your thought on the latest announcement or the deal of pausing or the China tariffs for 90 days? I mean, what
It's a pause for 90 days, and they rolled back the tariffs, where China is basically putting a 10% tariff on us, and we're putting a 30% tariff on China. It's still, the government has no business sticking its big fat nose in business's business. Business should be left alone, and as much as possible, you want free trade, and it's not going to. It's not going. The Bretton Woods system, where the dollar was tied to gold, flooded the world with dollars. That's what caused the dollar to be the world's reserve currency, was the Bretton Woods system. When the Bretton Woods system was ended by Nixon, we had something called the Smithsonian Agreement, and exchange rates were supposed to be fixed, but it just fell apart right away. And the default was the global dollar standard, because everybody had dollars. And so we went on this monetary system that we have now, but it was a total accident, and it's the most poorly designed. We've had 4 different monetary systems in the last 150 years. The world is overdue for the next one. I wrote about it in my book, and I made a video on it recently. I made a couple of videos. It truly looks to me like we're going to go back onto some gold standard, in which case you're probably going to see gold up at around $10,000 an ounce. Remember in February, Donald Trump was making all this noise about auditing Fort Knox. We've got to go see if our gold is there. For 2 weeks, it was this rhetoric about auditing Fort Knox. And then the rhetoric stopped, and everything became tariffs instead. Well, that audit was a threat that got things going. There has been massive gold inflows, such as we have never seen, into the United States. Well, actually, we saw big gold inflows in the buildup to World War I and during World War I, and then the same thing in the late 30s, just before World War II, and then during World War II. Massive gold inflows. But those were the last times. Now we're experiencing these massive gold inflows. Some of it is going to the commodities exchange, but it's not actually going like to retail. There are whales accumulating gold, but I also believe central banks lease gold. This is a fact. And so if the gold it's called rehypothecation. If the gold has been rehypothecated, then somebody else basically has the title to our gold. The U.S. is the largest single holder of gold in the world. Donald Trump tweeted out about negotiations that he that has the gold makes the rules. So I put together a video just connecting the dots, where Donald Trump, in 2 different videos, talks about how great the gold standard was. where Scott Bessent, the Secretary of the Treasury of the United States, says that within the next 4 years, the world is going to have a new monetary order, and I want to be a part of that, something like a Bretton Woods. That was the last gold standard that we had, Bretton Woods. And when he says new monetary order, he's talking about the monetary system. A new economic order is the way he said. We're going to have a new economic order, something like a Bretton Woods system. And then I connected it with another video where he talks about how when he had his funds, he was basically considered a gold bug. He loves gold. And there's just all of these breadcrumbs that taken together really look like we are headed towards some global monetary system. And remember, we had the classical gold standard before World War I. We had the gold exchange standard between the wars. We had Bretton Woods from 1944 to 1971, and then the global dollar standard from 71 until today. And the global dollar standard is the most poorly designed. It's showing its stress cracks and weaknesses, and that's the reason the Secretary of the Treasury was saying the world needs a new economic order. And so I truly think that gold is going to underpin the global monetary system. Now, I just wish we would go back to gold and things would be priced in nanograms and milligrams and grams of gold, because it's a one world currency. National fiat currencies, the way they come into existence is through fraud, theft, and enslavement. It's actually, the more you dig into it, and people can look at all of this. I mean, I spent 4 years with 2 researchers that I was paying. We're working full time on the Federal Reserve's websites, the Bank of England, the Government Accountability Office, the Bureau of Labor Statistics, the Congressional Budget Office, the White House. And that's what went into researching my latest book. And if they go to ggsr21.com, I'm not even asking for an email address. I just want people to have this information. There's 3 chapters there for free from my book. The chapter number 4 is the hardest. That one is how currency is created and how it causes fraud and theft. And you should watch the accompanying video. I take a little detour and I show how our monetary system is causing this wealth transfer from the poor and the middle class to the richest. And it's all of Ben Bernanke's, whenever we did quantitative easing, it makes the rich richer and the poor poorer. It steals from anybody holding dollars or making dollars on like a fixed salary and transfers that wealth to the richest people on the planet. And I show the checkable deposits of all of the different aggregates, the bottom 50%, the 50 to 90%, the 90 to 99%, the top 1%, the top 1/10 of 1%. And it looks like a lot of currency went to the bottom 50% until you compare it to the others. And the richer somebody is, the more that they got. And that's what caused all of the raging inflation that we had since the lockdowns ended. All of that currency came out of hiding, and the rich got a disproportionate share of that currency that was created during the pandemic, and it comes back to haunt us as a devaluation of the currency. The cost of living isn't going up, the currency is going down.
Mike, what would happen to home prices and the stock market if we went back to a gold-backed dollar or gold-backed monetary policy? I mean, wouldn't that be? I mean, that would be catastrophic at some levels, wouldn't it? What would have to happen in order for?
Well, in all of the gold standards that we had, it was only the gold notes, the things that are in your pocket, what's in your bank account, anything that's digital, isn't created by the Federal Reserve or the government. It's bank credit. It's created by the bank. 92% of our currency supply, the dollars that exist, is bank credit. It's not Federal Reserve created, and the U.S. government had nothing to do with it except for setting some regulations. Currently, if you take the number of ounces of gold that the U.S. claims to have, and you divide it into the currency in circulation, you come out with $9,044 gold to fully back all of the Federal Reserve. People will say that the Federal Reserve notes aren't backed by anything, and it's completely untrue. The Federal Reserve notes are 0.04 cents of gold backs every dollar because they keep the gold on the books at 42.22222. It's 42 and 2/9 dollars, and leave it to the government to pick an irrational number. 2/9 is not a resolvable number. It's 42.222222 on into infinity. It's not resolvable. It goes on forever. And that's the official statutory price of gold. Now, in order for the gold that the U.S. has to cover all of the Federal Reserve notes that are out there, it would require $9,044 per ounce of gold. That would be the price. And the government can do this. A gold standard is self-funding. You just declare a price of gold and you stand ready to buy or sell unlimited quantities of gold at that price. And at $10,000, the U.S. government would become the world's biggest buyer of gold. And the way you buy it is you print a note that says, I owe you gold. You buy the gold, and now you've got the gold that backs up the note that you just printed that you just bought the gold with.
Why wouldn't they do that?
Scam. What?
Why wouldn't they do that? Why? I mean, that sounds like a great idea to me. I mean, that would stabilize the economy. I mean, what is the downside?
Well,
for
they
them?
may. That's what I'm saying, is they may do what will happen is real estate isn't going to crash. What will happen is prices will stabilize for as long as, except this is only the gold notes. If we went back to using, we used to have a banking system where you would deposit gold or gold notes, and then they could loan that out at a higher. When you deposited it in a time passbook account, it's a checking account, but it's a time deposit. So like a savings account, a time deposit, where you're paying a penalty if you withdraw it early. They're going to give you a certain interest rate, and then when you take out a loan, the loan is a higher interest rate, and the bank is making that spread. That's how they stay in business.
That's the way it used to be. Right.
That's the way it used to be, and it was honest. Today, the way currency is created is you find a house. The house is $1.2 million, and you take this $1.2 million house to the bank, and you say, I need to borrow $1 million. I found this house that I want to buy. The bank looks at you, says, well, you've paid your loans back in the past. You're a good credit risk. Yes, the collateral is worth more than you're asking for it, so we will loan you the currency. They don't have the currency to loan you. Loans create deposits, and this is verifiable. The Bank of England made it very, very clear how it works in their, I can't remember the title of the document, but it's all in that chapter 4, which is a hard chapter to get. But if you get it, you'll understand how the world economy works and how the entire monetary system is based off of fraud, theft, and enslavement. You think the bank is loaning you something that already exists. Your signature on that loan document gives the bank an asset, the mortgage, and then they type a liability for them, the bank credit, into your checking account. And so it's created. It comes out of thin air, basically, based on your signature on the loan document. You now have the $1 million in your checking account. You pay the seller. That $1 million of empty currency that had no purchasing power is now out in circulation. Where does it get its purchasing power? It gets it by transferring a minute portion of purchasing power from every dollar in existence because it just diluted the currency supply. So it was fraud, it was theft, and now the bank is going to charge you interest on something that they whipped up out of thin air and did not, You borrow $1 million, and over 30 years, you're going to pay back $2 million. Except at first, it's almost all interest that you're paying. You're not paying down the principal for the first few years. And that is a form of enslavement because they're making a living off of you at no cost to them. When it comes to the Federal Reserve, the way the dollars are created is they buy a bond through one of their primary dealers. There's always 18 to 32 primary dealers. These are the largest brokerage houses in the world. And it's the Federal Reserve Act limits the Federal Reserve to where they can only buy in the open market. So what they did was they created their own open market. The primary dealers also have to show up at the Treasury and bid at the Treasury auctions. And so it's this limited market where you and I can't buy in that market. Only the Federal Reserve can buy in that market. But there is this competition where these brokerage houses are basically bidding to get the contract from the Federal Reserve. But the Federal Reserve buys a treasury from these primary dealers in what is they consider an open market, and then they create the currency to buy those treasuries. Then the primary dealer turns around next week and shows up at the auction at the Treasury and buys another bond. What is a bond? It's an IOU. Loan me $1 trillion today, and I promise over 30 years I'm going to pay you back $2 trillion, $1 trillion of interest and that original $1 trillion. How is that bond paying back the principal and the interest? From your taxes. You have in order for a Federal Reserve note to exist, you are enslaved. And so it all comes about through fraud, theft, and enslavement. It's a highly immoral monetary system. When we used gold, there had to be a prospector that would go out and find a claim. The claim had to be turned into a mine. The mine had to dig up a bunch of ore that then goes and gets refined and poured into bars, and then the bars get melted down and minted into coins. The amount of labor that took, the human element in it, it was all when it came into existence, it was already charged up basically with purchasing power. You then want to buy a house. You have to save up this stack of coins, and you have to do an equivalent amount of work that it took to make those coins. And then you buy a house, and you're paying the equivalent amount of work that it took for people to chop down the trees, dig up the cement and the ore to make the copper wiring and the copper plumbing, and pay all those guys to hammer all that timber into a house. And so it was a three-way trade of exactly equal value. And today, instead of a three-way trade of value, it's all based on fraud, theft, and enslavement. No matter how currency comes into it, national fiat currencies are a scam that enslave us. Money, gold and silver, sets you free. Sorry, I went off on a tangent.
No. I mean, it's what do we do? I mean, how do we get out of this system that it has been predetermined for us, predestined, pre-designed, and
well, with national currencies, it gives the government a lot more control. It gives you control over you, how you can travel, what you can buy, and then the ability, especially when a country gets into a war. During a war, they light up the printing presses and they do a lot of deficit spending. That dilutes the currency supply, but during a war, people they have a lot of anxiety. So they save. The currency doesn't circulate. So while they're diluting the currency supply, they're actually stealing wealth from their own population, any country in a war, because to win, they've got to outspend their opponent. And so what they do is they confiscate the wealth of their own population. When the war ends, that currency comes out of hiding and starts to circulate, and you have these big inflations and in a lot of cases, hyperinflations that you see in World War I and World War II.
Are we heading to war?
I doubt it because, I don't know. It's tough because it is so easy for wars to escalate And it's so dangerous that this could be the end of the world. If we, with Ukraine, it was looking really dangerous there for a little while. At least that tension has eased a bit. Um, but I mean, we were actually closer to nuclear war than as close as we were during the Cuban Missile Crisis. It's extremely dangerous, and it's really easy for these things to get out of control. And so, one of the things that gold does is it creates a more peaceful world. If you're actually using gold as your money, if the government wants to do deficit spending, they have to borrow gold out of the free market. When they borrow gold, it causes interest rates to go up. Remember, that's the savings, and they're and it's the circulating medium. And when they borrow it out of the economy, people want higher and higher interest rates to be able to borrow it. When that happens, the GDP, the economy starts to slow down, and there's less tax revenue. So when the government does crowding out of the private sector, they can't borrow too much. It limits deficit spending, because if they borrow, they actually collapse their own tax revenues. And so it keeps governments all over the world under control. And what you have is, around the globe, you have these little bubbles that are a bubble, and where one economy has a recession, another one will have a little bit of an economic boom. When it has that economic boom, it starts importing stuff from the country that has a recession, and where people are working for less, and goods are cheap. This country has an economic boom. They pay with gold, and their economy deflates, and the economy that had a recession inflates because they've got more currency, more money in the country, and so it's a automatically adjusting, self-leveling mechanism that puts all economies on the same footing. Now, we have the global reserve currency, so we probably don't want that. I hate to see gold. I'm on the record for saying gold standards suck. Gold is great. If we actually used gold in payment, it would be a much fairer, more peaceful, more prosperous world, I believe. The credit creation causes the business cycle. So we take 3 steps forward and 2 steps back versus 2 steps forward, 2 steps forward, 2 steps. It's slower growing, but no crashes. The credit creation causes misallocation. You have the economy heats up, everybody borrows, and we saw this during the Alan Greenspan took rates too low after the NASDAQ crash, trying to get the stock market to go back up, and accidentally created a real estate bubble that was a really disastrous thing that was caused by Alan Greenspan. Well, Ben Bernanke, there's going to be ramifications that every time we've had the threat of the economy, the free market always wins. When the economy overwhelms the manipulations that the government has done, and the Federal Reserve, there's a big old crash. And what it's trying to do is balance the stock market with the rest of the economy, or real estate with the rest of the economy. When you see, the mortgage to income ratio going up really high, that eventually has to come back into balance. And then the government will prevent that by making some sort of subsidies or taking interest rates down really low again. They want us to constantly live in these bubbles, and the free market is always trying to level everything and make it balance again. And the more manipulation they do, and the further they push it out of whack, the more devastating the leveling will be, the balancing.
Well, I think that's where we are right now. When we look at the housing affordability index back in 2006, at the peak before the GFC, the median income household could afford a median income or a median priced home. Now that has dropped considerably lower, where they can't afford it, and on a median income today. I think that even dropping the interest rates should we see quantitative easing where the Fed buys mortgage-backed securities again, like they did when they dropped rates to near zero in 2007? It didn't work. I think the asset prices have gotten to a point now where even if interest rates drop, if we see the 10-year Treasury adjust to where mortgage rates go even close to 4%, I don't know that with the cost of everything else, the repair costs, the insurance costs, the property taxes, I still don't think we'll be in an equilibrium. What do you think about the manipulation? Well, I guess let me ask you this. We had tariffs on, off, on again, off again, on again, off again, negotiations, whatever you want to call it. It seems like the stock market fluctuations were high, low, back to highs, back to lows. What's the deal with that? When does the overvaluation of stocks show up? When do we start to see where who's manipulating that market? Is it purely the wealthy people that are playing this game, arbitraging the ups and downs of the seems almost daily highs and lows of the stock market? When does that all of a sudden not work anymore and trigger us into what you're saying, higher unemployment and people not affording to pay their debt?
Well, yeah, people right now, there's a lot of people that can't afford to pay their debt currently. Auto loans that are in default are at an all-time high right now, as far as how far back the data goes, even higher than in 2009, 10, and 11 after the global financial crisis, when people were losing their jobs and all of that kind of stuff. The S&P right now is at 5892, but the all-time high was 6150, basically. So it's been creeping back up there. You mentioned is this big players? I'll tell you this: the insiders that know what's going on, 90 minutes before Trump did the pause on, I think this is when he paused Mexico, Canada, and some others for 90 days. 90 minutes before, the number of calls on the NASDAQ, options, betting that it was going to go up, spiked hugely. So these are insiders in the government that made a fortune off of that. We know the Fed's playbook, right? If there's a crisis, drop interest rates close to zero and print. They've only got two hammers. Maybe one is a flathead and the other one's a ball peen hammer, but they're hammers nonetheless. Everything has to look like a nail, and so that's going to be their remedy.
You think it'll work?
No. Well, it how when you're building a house, you're putting up sheetrock or wall board or cement board or whatever you call it, and then you tape over the crack and you spackle, right? There's a crack there still, though, and that crack, if the house shifts, can appear later. It's not one continuous sheet. Well, we've got cracks appearing all over the economy, and we keep on papering over them by creating currency and dropping. When you drop interest rates to zero, you're basically having the banks create the currency for you. So, I said 92% of the currency supply is bank credit. You drop interest rates to zero, and eventually the banks do start loaning again. They get very scared even when you drop interest rates to zero. It's hard to get a loan right after, like a real, unless your credit is just stellar and you've got this great reputation and you can prove that stuff cash flows, even though like, when you're in apartment buildings that are low income apartment buildings that people have to go to as they lose their jobs and stuff. So your vacancy rate is not going to skyrocket. Then a bank will loan to you. But during these crashes, banks become very, very defensive. They really protect their balance sheets. They're worried about any loans going bad. And so even with interest rates down near zero, sometimes for some people, it's pretty much impossible to get a loan. But eventually, the banks start creating currency. So that's the reason the Fed manipulates interest rates. They're manipulating the currency supply up and down by having the banks do it, create the dollars for them. Then they also create base currency, which the bank reserves are a type of dollar that you and I have never seen. We've never come in contact with one, but it's on the bank's balance sheets. And so most of what Ben Bernanke created through quantitative easing was base currency. And then when they'd buy, this is interesting, when they bought all the bonds and the mortgage-backed securities for QE, it created two forms of currency, base currency and bank credit, both. So they buy a mortgage-backed security from the primary dealers. The primary dealers cannot be banks. It's in the Federal Reserve Act. But J.P. Morgan, brokerage that's a primary dealer is under a corporate umbrella that has J.P. Morgan Chase. Bank of America Securities is a primary dealer, and they've got Bank of America under the same corporate umbrella. So the Fed buys from the brokerage arm, but they can't pay the brokerage arm. So they create base currency and they send it to the retail bank with the instruction to create $1 trillion and deposit it in the arm of the broker, not $1 trillion, but billions of dollars. It adds up to trillions. With the instructions to create bank credit and deposit it in the account of the brokerage house. And then some of it goes into the stock market. In my book, I show the incredible, I think it's in chapter 4, so it's free. It's near the end of it. The correlations of quantitative easing and other manipulations that the Federal Reserve did with the stock market. And it's like 0.97 and stuff like that. So it's 97% the same. They create $1 billion worth of currency and 997, the stock market goes up by 997 million at the exact same time. And so it's not a coincidence when that tracks for so many years with these super high correlations. So they manipulated the stock market. What they're trying to do is paint a false picture and make people feel good. But what it's done, too, is when everything gets out of whack, it prices homes, like if they drop interest rates to zero to keep them from crashing down to where they're balanced with the incomes of people. People can't buy a starter home. For anybody that's young trying to own a home, it gets priced beyond them by the Federal Reserve, pushing things back up into a bubble because they won't let things balance. When in my book, I go through all of the different things that are in a bubble in chapter 5, which is not on the free chapters online. But I show that basically the only way that you can measure the stock market as not being in the greatest bubble in history is the price-earnings ratios. So the price that you're paying per share compared to the earnings that the stock makes per share. Other than that, the number of work hours that you have to work to buy to equal the points on the S&P 500 has gone from, for the average person, it's gone from about 30 hours, where it was at for like a century, bouncing between 20 and 50 for a century. And then we entered the bubble century, where the central banks are manipulating everything. And now it's at 130 hours instead of 30. It's at a high. There's never been anything like this. Not the bubble in 1929, not the bubble in 2000, and it's the same with a whole bunch of other measures of how overvalued the stock market is. And not all real estate is the same. I bought a bunch of farmland down here in Puerto Rico. I've got a 900-acre farm. That's where I'm sitting right now. And it was not it was not in a bubble or overvalued. In fact, it had been heavily hurricane damaged from Hurricane Maria and pretty much abandoned. This farm was created in 1865. I'm the second owner.
Wow.
And so I got it for what I come from California. So I consider it pennies on the dollar, but a
Yeah.
local wouldn't. A local would have seen it as I just got a little bit of a bargain on it.
But you're on 900 acres. You're off the grid. And so says the man that we won't have a war. You have this compound. So,
yeah, I'm completely off the grid. This is a very defensible compound, basically. Our gates and all of our locks are biometric IDs. So we get basically, you have to use your face to get in and out of the gates. And so we get a picture of everybody coming and going. And then I've got a mountain on my property that's 800 feet up. I hike up it actually every morning. I'm at about 2,500 feet, where it's always 10 degrees cooler than San Juan and about 12 degrees cooler than Mayaguez or Ponce, some of the other large cities on the island. So,
well, Mike,
yeah.
let's talk gold, silver.
Okay. I know something about that.
Yeah, I'm curious because I know you say, and I'm sure a lot of people that have physical gold would love to see gold hit $10,000 an ounce. So if they bring it back to back the dollar, and your calculation is correct, which I'm sure it is, and gold.
Well, if they're going to do a reserve ratio, it could be a lot less than that. In the intra-war, once the Federal Reserve was established, before the Federal Reserve, it was 100%. All Treasury notes were 100% backed. If there was a $20 bill in circulation, there was a $20 coin in the Treasury's vaults. The Federal Reserve, it was a 40% reserve ratio when in the intra-war gold standard. And then that sort of blew up when the Great Depression hit, and they didn't have there were bank runs and people were asking for gold, and they had to make private ownership of gold illegal. And then they changed the price of gold. You can't change the price of gold when the world is on a gold standard. All you can do is devalue your own currency. And so over a period of, I believe, a month and a half, they unpegged it, and they let the exchange rates float, and then they repegged it. They unpegged it, repegged it. And the dollar went from 1/20th of an ounce of gold to 1/35th of an ounce of gold. And in doing so, we had enough gold to back every Federal Reserve note that had been created when we were actually on this 40% reserve ratio previously, and they had inflated for World War I. And it caused the roaring 20s. We did have, your audience has probably never heard of the Depression of 1921, but it's the greatest contraction of wholesale prices the country has ever experienced, much greater than the Great Depression. And but the government didn't rush in to save us. The Federal Reserve didn't rush in to save us, and so we were out of it in like 18 months. We were out of something that was actually a more severe price contraction than the Great Depression. The Great Depression was caused by the government with Smoot-Hawley tariffs. When they introduced tariffs, it slowed down our economy and the global economy. And then the Federal Reserve, with what they did with the currency supply and interest rates in 1930, and 33, and then banning gold in 33 and in early 34, they called it changing the price of gold, but they devalued the dollar. That's all it was. Gold went from $20.67 an ounce to 35, except every other country in the world was using gold in settlement. And so what you're doing actually is just devaluing the US dollar. And so we've been through this playbook before. We're starting it again. If gold goes up to wherever it's going, if they go, even if they just select the free market price, they're changing the statutory price of gold from 42 and 2/9 dollars up to whatever the free market price is, currently like $3,300. That's a huge leap. But with the number of ounces that we've got, the number of ounces at the current market price would give us about 800 million or $900 million extra over the, it would be, they call it a windfall, but the Federal Reserve would be creating these dollars that then get deposited into Treasury General account and would reduce our budget deficit. However, if they just declared $10,000 is a nice even price, and it would give them, if it takes $9,044 to cover all of the Federal Reserve notes, $10,000 would give them a little runway for some deficit spending. So it would be it's actually a sensible price. It sounds crazy, but you know what? I just did a video. I believe we're going into the third stage of the gold bull market, where there's three phases, and in the final phase, where it starts to get media attention, and like it's been on the cover of Barron's lately, and the front page of the Financial Times, and this wasn't happening in the early stages. Gold was ignored, and even Wall Street Journal is telling you how to invest in gold. If in the third phase, you have the greatest gains of the entire bull market in the shortest period of time. Like in 1979, December 3rd, gold was at 400 and something, and in 29 trading days went to 873. So it was, if in 1971, when Nixon took us off of the dollar and gold was $35 an ounce, if you said it was going to 50, people thought you were crazy. A lot of economists said that the price of gold was going to fall. If you said that $100 was possible, I wrote in my book, you would be tied up, hauled away, and placed in a rubber room because you were certifiably nuts if you thought gold could go to $100. And it went to 873. And so anybody that, it's been interesting watching this. When gold was $2,000, analysts were saying, well, it could go to $2,200. And so they'd say, Bank of America, Goldman Sachs, all their analysts were saying, and it ends up at 3,000. And then they are always raising their targets after their targets has been passed. That's when they raise their target a little bit above the next target. I don't particularly like to give dollar-based targets. Gold, the price doesn't matter. It's the value that matters. Then there's a big, big difference. The price is how many dollars it's worth. The value is how much real estate, barrels of oil, tons of iron, shares of Dow, shares of stock, all of the different things that you can buy in society. And when you take these long-term charts and you divide one thing by the other thing, you still discover that right now gold is severely undervalued. And right now, I believe we're at about, it takes 12 ounces of gold to equal the points on the Dow. In 1932, when the Dow crashed and bottomed, it was a breath away in 29 from 400 points. I think it was 396 or 397. And when it crashed down in 32. There was a day where it was at 40.22 points. So it only took 2 ounces of gold to equal the points of the Dow. Then in 1966. So in 29, it took 18 ounces of gold to buy one share of the Dow. In 32, it took two. In 66, it took 28. In 1980, it took one. The day that gold hit 873, the Dow was at 873 points. And then we went into the biggest stock market bubble in history as far as the Dow gold ratio goes, where it took 45 ounces of gold in the year 2000. And then now, in 29 to 32, gold was fixed. It didn't move. In 66 to 1980, the Dow was fairly fixed. It rose up and bumped its head on 1,000 points and couldn't break through for 16 years. So it's bumping along sideways. That ratio change is gold going from $35 an ounce to $873 an ounce in just 8.5 years. And then, we had this 45 ounces of gold during the NASDAQ bubble to equal one share of the Dow. It went down to, I believe, 6 or 9 during the global financial crisis, and then went back up to 16, and now we're down at about 12. However, it's probably destined to, and this sounds crazy, except there's a lot of math and logic backing this up, and evidence and history. But it looks like it should be going down to where half an ounce of gold will equal the points on the Dow. And so if we're at 12 right now, it means that if you sell stock and buy gold, you'll be able to buy, if you could catch the peaks, and nobody can, that you could buy 24 times more shares of stock someday in the future with the proceeds from that ounce of gold. It may not go to a half ounce, but what I'm trying to do is use math and a whole bunch of indicators. Gold as compared to the size of the U.S. currency supply, gold as compared to real estate, oil, the Dow Jones Industrial Average, the gold-silver ratio, which acts as a confirming indicator. So I've got something called the Insiders Program, where people that buy, I believe it's 10 ounces of gold or 500 ounces of silver, get to learn what I'm doing with my investments. And then I have an exit strategy where I'm going to be measuring all of these different things. The Dow gold ratio, before you sell, it should at least be below 5. And I'm looking for 2, 1, 1/2. And I'm going to be using the gold silver ratio. In 1980, when gold peaked at 873 and silver peaked at 52.50 was the intraday high. The gold silver ratio dropped from 50 down to 14. So it only took 14 ounces of silver to buy an ounce of gold. The dynamic that's going on there is, as gold is rising, it was 35. It rose up to at 400 in October of 79, and again at 423, I believe, was the high in October of 79. People started, when the gold panic happened in December, and people were lining up, the lines at coin shops when the news media was interviewing them. In my book, I've got quotes from Time magazine and stuff, and they were comparing the lines at coin shops to Star Wars and Apocalypse Now. I interviewed the coin shop down the street from me. I remember in 1980 the helicopter shots of this line of people filling the sidewalk and going up to the corner and down the side street to get in there. And I interviewed them after I wrote my first book, and they said that, that was they were getting 2 deliveries from Brinks every day, and by closing time, there was not a single scrap of metal in that place. So they had to turn people away that would then show up the next morning to be first to get theirs. And so that panic, once gold surpassed, in 1980, the average income of an American was just below $10,000. It was 9,000 something. So a guy in his 40s might only have a few $1,000 in the bank. He rushes to the bank. He takes $500 out, rushes to the coin shop and says, I want to buy gold too. And they plop one coin in his hand. And at that point, he goes, is that all I can get? How much is the silver? Oh, well, you can get 50 of those for one of these. It's when the public changes their preference from if silver hasn't performed as well as gold, it suddenly will. And when it does, it outperforms. Gold rose 25 times from 1971 to January 1980. Silver rose 41 times. And most of that move happened right at the end. And right now, the gold-silver ratio is over 100.
Yeah.
It takes over 100 ounces of silver to buy an ounce of gold. If you measure how many times this has happened in the past 2,500 years that gold and silver have been money, it is measured in weeks. This is an this is an opportunity that since gold and silver have been around, that is measured in the thousandths of a percent of time that we've got right now. Silver is tremendously undervalued. And as this goes forward and gold becomes perceived as being too expensive, which I think will happen at around $5,000 an ounce, somewhere, it's already been 3,500. But the public isn't doing the buying. The retail sales like U.S. Silver Eagles and Gold Eagles is actually down. Our sales are down.
Well,
so
the central
public, huh?
Will the central bankers ever start buying silver? I mean, you look at an ounce of gold, it looks like a thin mint. Or, an ounce of silver, too. I mean, these are very, small sizes. Right. You're talking about, 3,200, 3,300. It's hovering around there for an ounce of gold. When should people say, it's hard, will there be anything that could happen that you could think of to where gold would get back down under 3,000 where maybe more people would be buying it? Or do you think that we won't see? Do you think this most recent dip from 3,500 to 32 something, do you think that's it and we're going past 3,500 and people should just start buying silver now? And when will silver take off? If you're looking at it, what would it take for that other than people saying they can't afford gold?
Silver is a wild ride, and you need to have the stomach for it. Gold is much smoother. It's not as volatile. When gold goes up $1, silver tends to go up like $3. But if gold goes down $1, silver will go down $3 or even $4 sometimes. So it is a wild ride. You have to have the stomach for it. But, I know the history of it. And so I think I know what's going to happen. As far as, is gold going to go back down below 3,000 or back down to 2,000 or something like that? You need to ask yourself, is the Federal Reserve and the government and the banking system ever going to stop creating currency? Is the government going to stop doing deficit spending? If there is a giant market crash, what does happen is when there's a liquidity crisis, when people that are out on margin on the stock market, when they've borrowed to buy stocks, they get a margin call and they have to get liquid. And sometimes they just sell everything on their trading platform. And when they do that, gold gets sold a lot. It's throwing the baby out with the bathwater. Gold gets sold at the same time. So we saw this in 2008 with that crisis. Stock market started to crash. Real estate started to crash. Gold went through a crash also. It was $1,100 before the crisis, and it went down into the high 700s. But it did that very quickly, and by October it turned around. The stock market continued to crash until the following March. So it turned around very quickly, and it took off like a rocket, and it went from 700, the high sevens, up to 2,100 very quickly, or 1,900, and then 2,100 later. And so, and silver fell down, I think, into the 8s. And I pretty much doubled my position and had an average buy-in price at $11, and now it's $33. And then during COVID, it went down into the single digits or $10, and I bought a bunch more at 11, and I added about I already had a lot of silver, so adding more than like 20% would have been I added about 20% to my holdings during that crash. I do like buying dips. I used to buy just consistently. Every single month I would buy. And it's a great dollar cost averaging in is a great way to go. And I've never really sold any of my position, but what I do is I I did once just temporarily, and then I bought it back. I needed cash for something else. And gold and silver is highly liquid, so it's uh, depending on how busy Brink's security is. It can be more liquid than a stock if they're not very busy. If they do get too busy, it might take a few days for settlement uh, because uh, all of it has to be transferred to vaults at Brink's. So anyway, I forgot what the question was,
Well,
but
just talking about,
yeah, will it
should
crash
people wait
again?
for something to dip to buy gold, and then, if you don't think it's going to drop? I mean, I know you don't have a crystal ball, but then what about silver? What would it take for silver? Besides the fact, I mean, of people thinking that gold's too expensive, if the consumers aren't the big buyer driving the gold prices, I would think the consumers would be buying more silver because it is more affordable. But what would it take for that, other than saying that it has industrial value? What else would it take for silver to get, some of the get closer to those
Well,
gold
um,
multiples?
first of all, yeah. So you mentioned industrial value. Okay, so it's used in solar panels. It's used in batteries. It's used in all electric cars. It's there's just silver is the second most useful commodity that mankind has. Oil is the most useful. Making plastics, all these different things that you can make from oil. But silver is in almost everything. Your light switch has silver on the contacts. Your computer has a whole bunch of silver in it. Cell phones, any big screen TV, or any screen that you look at, your computer screen, your TV, a mirror is silver. Thermal windows have silver in them. Superconductors have silver. And so it's pretty much everywhere. But we use it up in these tiny quantities and we throw it away. Almost all of the gold ever mined throughout history, more than 95% of it, is still above ground somewhere. It's mostly central banks, but then investors hold it. It's in jewelry, it's in art, it's in electrical contacts that are exposed to weather because it doesn't tarnish. And But we are having a fundamental supply demand issue with silver right now, where it's been in a deficit. For the past 5 years, we've been using more than we have been mining. So whatever does exist above ground is being drawn down. Now, if you give me a second here, I might be able to read you something that is, I think you will find very interesting. The Okay, there's a gold silver ratio. It is in this one. Okay, so supply demand. Um, okay, so how much silver exists in the ground compared to gold? Well, it's about 19 to 1. There's 19 times more silver in the Earth's crust than gold. However, the mineable supplies have been falling. So, how much silver do they mine each year compared to gold? They mine 7 times more silver than they do gold. How much is available in stockpiles? Only about 3 times more. So, for every ounce of gold that exists above ground that's available in stockpiles somewhere, there's 3 ounces of silver. So what's the price of silver compared to gold? It takes 102 ounces. I don't know what it is right now, but it's probably just over 100 somewhere, right around 102, to buy 1 ounce of gold. None of this adds up, especially when you consider that silver is industrial. Gold is mostly used for investment, central banks, and art and jewelry. And so if the world, because of these tariffs and stuff, this truly could kick us. It'll create at least a pretty bad recession if Trump doesn't solve this like right away, this week, next week. The longer it drags on, the worse this is going to be. But if the world goes into a severe recession, there will be less mining of base metals. And more than 60%, about 2/3 of all the silver that comes from mining comes as a byproduct of mining these base metals. And so that 1/3 that's actually primary silver producers, they cannot fill the void if there is a rush. Now, if there's a recession or a bad depression, retail sales will slow down and the amount of silver needed for industry will fall. So we won't need as much. However, it's monetary demand. When people come rushing into silver, a whole lot is wanted when very little exists. And that's the reason silver skyrocketed during those last months. It went from $4 to $52.50, I believe, in December and January of '79. And the same dynamic will happen. When that guy rushed in with his $500 to buy gold, and it just seemed too expensive at $500 an ounce, that's when he was asking about the silver, and the public switched their preference from gold to silver. And the same thing will happen this time, but probably at around $5,000 an ounce. And you will see this come back down to, I think that we will probably see a gold silver ratio like, and this sounds insane, but if gold goes to 10,000, we will probably see a gold silver ratio. I think it could be a 10-to-1 ratio, possibly, but that would point to $1,000 silver. However, I need to read you something from my book. And this is on. Okay. So what I did was silver was in a bubble in 1980. So was gold. When they were out of whack with the rest of the economy, caused by a monetary panic. They were rushing toward it because it was going up at first, and then they got worried about the dollar. And we're having these dynamics with the potential for war and these trade things and the potential for a depression. And people are trying to protect themselves. And U.S. Treasuries, which were used to be the safe haven, are starting to be eyed with a little bit of suspicion. Can we really go on with all of these deficits? Is the dollar that sound? So it used to be cash and U.S. Treasuries that were the safe havens and gold. But now increasingly the safe haven is just gold and silver. But versus 1980 today, this is with gold. There's 18 times more people around the world that can legally buy gold than in the bull market of the 70s. In the 70s, it was illegal in the USSR, and there were no markets to set a price. There was no exchanges. Same thing in Mao's China. In India, there was some products of gold that people could buy during the wedding season and stuff. But
jewelry, right?
Jewelry. Bars and coins were illegal. And so about a third of the world, it was illegal. And then the rest of the world, Africa, do you remember? I'm older than you are, but do you remember back in the 80s, the commercials on TV to try and raise money for the starving children in Africa, or the starving children in South America, or the starving children in Southeast Asia? These places were all starving, and today there's billionaires in all of these places. So there's 18 times more people around the world that can either legally buy or afford gold and silver than there was during the bull market of the 70s, where gold went up 25 times and silver went up 41. There's 55 times more currency on the planet. That's what the OECD says, the Organization for Economic Development, Economic Cooperation and Development. There is 56 times more millionaires, there's 200 times more billionaires, and there's 220 times more consumer credit available. And then the next chapter is where I analyze silver. And if you just adjust silver, the 5250 high from 1980, and this has changed because I completed the book in the summer of 22. So this has changed and gone up since then. But the consumer price index, it would be $200 today. If you adjusted it for the same growth, the same percentage growth for this single family median price home, it would be $468. If you adjusted it for the growth of the Wilshire 5000 stock index, and there aren't 5,000 publicly traded companies anymore. So the Wilshire 5000 actually only contains about 3,500 publicly listed companies. It would be $2,178 per ounce. If you adjusted it for the 10-year Treasury bond, it would be $1,059 per ounce. If you adjusted it for the growth in GDP, it ends up as the same as the median price home at $468. If you adjusted it for currency in circulation, it would be $971. If you adjusted it for the M2 currency supply, it would be $781 per ounce of silver. And so there's the low here is 200. The high is actually the Wilshire, and the average is $921 an ounce. So $1,000 silver is possible. So that would bring us to a 10-to-1 ratio. But if they went with $10,000 gold, and I'm not saying that will happen, I do think that $5,000 or $6,000 an ounce, though, is inevitable. It's just gold accounting for the growth of the fraudulent fiat currency supply. And it did this in 1934, and it did it in 1980. There was about a month where the value of the gold held by the Treasury was greater than all of the Federal Reserve notes that had been printed from 1914 until 1980. And so if we did $10,000 an ounce, that would just be history repeating. It wouldn't be anything more. It wouldn't be unusual. And so people think when I say stuff like that that's nuts, but it's not, because it's happened before, twice in the last century.
Well,
So-
what a masterclass. I tell you, Mike, I can't tell you how much I appreciate you breaking everything down. And I know that our audience has been going through this the last couple of years and just wondering, what is going to happen, and what's happening with their money. And I think that I'm listening to you, and I'm thinking that, I need to make some changes as well. But I can't thank you enough, sir, for doing this. And all your links are in the show notes, and I can't wait to come back to Puerto Rico and see you. Hopefully by the end of this year, I want to check out that 900-acre farm that you have now that you've been working on so hard. But
this time I'll have you up at the farm, and we can go up to the top of my mountain at sunset and have a sunset salute, a toast.
That sounds great.
Yeah, it'll be great.
Well, safe travels to your upcoming events and that you're speaking at, and we'll be talking to you real soon.
Okay, and thank you.
You got it. Thanks so much for watching. If you like the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.